Spoke about the rupee. We'll get to what happens to IT in just a bit, but joining in now is Abhilash Koikkara. He's the head of Forex and Commodities at Nuvama Professional Clients Group. Abhilash, very good afternoon and thanks so much for joining in today. Let me first start off with, how are you seeing the near-term trajectory on the rupee? What should traders watch out for?
So in the short term, obviously the bias of the rupee is towards depreciation. Rupee has broken the 90 plus levels, and as we speak, we are close to 90.40. So there are two or three factors, Puneet, which has played in. One obviously is the tariffs on India, which is among the highest in the globe, right? We are at 50%. Second, if you look at the trade deficit numbers, which came out in October, they were close to $42 billion, which is putting pressure on current account deficit. And since we had muted FPI and FDI flows this financial year, so we are seeing the balance of payment dipping into a deficit of close to $10 to $12 billion. The third part to it, and which is basically driving the volatility currently, is the market dynamics. So we are seeing exporters being on the sidelines, delaying their sales in dollar. And we are seeing importers very aggressively coming to hedge, especially after the 90 handle kind of got taken over. Also, the cost of hedging today for importers is only down to 2.3% per annum. So which makes a lot of sense for importers whenever they're in panic to kind of hedge their exposures. So these three factors, the higher tariffs, the current account deficit pressure due to higher import bill, and the market dynamics where there is delay in export sales from exporters is what is driving the rupee towards 90.40. In the short term, we feel that this can kind of get extended, Puneet, towards 91, 91.20 levels. Because as in case of any asset class, when there is extreme pessimism or optimism, we tend to overshoot. So in terms of levels, we are looking at anywhere between 91 to 91.20 in the short term.
Abhilash, the other key question is also of RBI's positioning, right? Because tomorrow we have the MPC outcome coming in. Largely, apart from the interest rate cuts, I think rupee is going to dominate a lot of those conversations. How do you see this position?
Right. So if you look at the RBI's intervention strategy, right? So as per our information, we are seeing close to $45 billion of selling in spot market. However, their intervention has been significantly higher in the forward market. So if you kind of take in the estimates of November, we should have close to $70 billion of sales in the forward market to kind of curb the depreciation path of the rupee. Now, there's a logic to it. The logic being, if RBI aggressively intervenes in the spot market, that kind of reduces the rupee liquidity in the system, right? We have just moved from a liquidity deficit to in the banking system to a liquidity surplus. So RBI is very carefully threading that part, and that is why most of the intervention is on the forward market. From a RBI perspective, what we have heard from the new governor is that they are okay, or at least it looks like they are okay for a broader range of rupee. However, they would like to curb volatility. And in the last meet, it was clearly mentioned that the 3 to 3.5% depreciation is a normal norm for rupee. So from an RBI perspective, obviously they have been trying to intervene to stem the volatility. But it as compared to a previous regime, it feels that they are more comfortable to have a broader range for rupee as long as the high volatility is curtailed.
My final question to you, Abhilash, you mentioned about the short-term trajectory of where the rupee could be a tad above 91 rupees to the dollar. What do you see the long-term trajectory though? Do you expect it to come down back again to the 18.8, 89 rupees against the dollar right now?
Yeah, in the long term, we are kind of looking at a favorable rupee appreciation, and there are two or three factors to it. One, I think once this, so what kind of really jittered the market was there were noises that the trade deal will happen in November end. Now there are noises that will happen at the year end. So once that is out of the way, and even if you get a tariff between 15 to 20%, I think that will push the exports up because there will be more clarity, right? So that will kind of self-correct the balance of payment a bit. Second, once that clarity emerges, we'll see FPI inflows coming into the market, which we are close to $17 billion of equity outflows in this year. So we will see then FPI flows come into the market, which will again support the rupee. And third, also, I feel that the market dynamics in terms of market positioning will change because we expect that there should be a 2.5% kind of correction in the rupee towards appreciation once the news is out. Even if you look at from a valuation perspective of the rupee, right? So currently we are around 4% undervalued on real effective exchange rate. Korean won is flattish for the year. Japanese yen is up around 2%. Chinese currency is up around 3.5%. we are down around 5%, right? So there is an auto correction which is also kind of due in the market, where we are from 4% undervalued. Even we come at par, that will lead to a 2.5% kind of appreciation. However, as I said, the main trigger for that will be some clarity on the US-India trade deal. And that is why from our perspective, from a 6 to 12 month perspective, we feel that rupee should appreciate to around 88 half once this trade deal information is out in the market.
Well, Abhilash, we'll leave it at that. Thanks so much for joining in, giving us perspective of what you see as the short term, long term, as well as the RBI move on the rupee as well. But let me welcome in Raghvendra Kedia, the founder of Prosperity Advisors.